You're listening to Uranium Spotlight on Tuesday, March 4th, 2025. Brought to you by Purepoint Uranium Group, your exploration partner in the most prolific areas of Canada's Athabasca Basin. With a collaborative investment model on district-scale projects and validation from industry leaders Cameco, Orano, and ISO Energy, Purepoint is investing in Canada's uranium future. And now your host, Chris Frostad.
This week on Uranium Spotlight, we look at what makes a winning deposit, Germany's pro-nuclear shift, and Westinghouse ramp-up. In recent weeks, the uranium spot price experienced a slight decline, closing at $65.30 per pound last week, down from $65.65 the previous week. The long-term contract price remains steady at $80 a pound. This minor fluctuation in the spot market reflects an ongoing period of relative stability, followed by earlier volatility. Notably, in late January, uranium futures dipped below $69 a pound for the first time in 16 months, reaching approximately $67 on January 27th, before rebounding to $71.35 by month's end. Despite these short-term movements, the broader outlook for uranium remains positive. Experts anticipate that prices will rebound to the $90 to $100 per pound range by mid-2025, driven by increasing global demand for nuclear energy and potential supply constraints. The uranium sector is dominated by a handful of big miners, Cameco, Kazatomprom, Orano, and a few others, who control the lion's share of global production. But while these giants set the tone for supply, it's the juniors that drive the discovery cycle, creating the next wave of potential production. For investors, understanding the dynamic between majors and juniors is key to spotting opportunities before the market does. Unlike commodities like gold or copper, where mid-tier miners can thrive, uranium presents a more polarized landscape. Juniors do the heavy lifting of exploration, often spending years or even decades to finding a resource before either getting taken out by a major or securing the financing to move forward. And because of the capital-intensive nature of uranium development, combined with strict regulatory requirements, most juniors won't ever reach production on their own. Majors like Cameco aren't necessarily looking for the biggest discoveries. They're looking for deposits that fit within their existing operations. Grade, location, permitting risk, these are all bigger factors than raw pounds in the ground. If a deposit is too low grade, it won't be economic. Too high grade, and it might not blend well with an existing mill. Too far from infrastructure, and it may never get built. That's why investors chasing the next Tier 1 discovery often miss the real story. A monster deposit means nothing if it can't be developed at the right cost or within the right time frame. Take in-situ recovery projects in the U.S. and Kazakhstan. These are typically lower-grade deposits, but because they can be mined cheaply and without massive upfront capital investment, they can be just as profitable as higher-grade underground operations. ISR projects often become prime acquisition targets for producers looking to expand production without breaking the bank. In Canada's Athabasca Basin, it's the mid-sized satellite deposits that often hold the most value. A smaller resource located near an existing operation with a functioning mill is far more likely to get developed than a larger remote discovery that needs billions in capex. Investors need to shift their thinking away from the idea that only Tier 1 deposits matter. The reality is the uranium industry has limited capacity to bring on new supply, and the bottleneck isn't just about size, it's about economics, jurisdiction, infrastructure, and how a deposit fits within the current production landscape. So where does that leave the juniors? Well-positioned companies with the right land package in key districts will continue to attract attention, especially as supply concerns persist. But not every discovery will make it to production. Investors should be looking for projects that solve a problem for a major, whether that's blending into existing production, filling a supply gap, or being de-risked enough to justify an acquisition. At the end of the day, a Tier 1 label doesn't guarantee success. What really matters is whether a deposit can be mined profitably, whether it fits within the needs of a major, and whether it can move through the regulatory process without years of delays. Those are the projects that will generate real value, not just for the companies, but for investors who know what to look for. This past week, German voters delivered a decisive shift in energy policy by electing a pro-nuclear government. The Christian Democratic Union, or CDU, led by Friedrich Merz, will now form a new administration marking a potential turning point for nuclear power in Germany. For uranium investors, this could be significant. Since Germany decommissioned its last reactors in April 2023, despite an ongoing energy crisis, many analysts have argued that reversing course would be nearly impossible. However, Mertz has stated that his government will explore whether these shuttered plants can be revived. The Radiant Energy Group, a consultancy with expertise in energy systems, recently released a report concluding that not only is a restart feasible, but it's also the best course of action. The question now is whether the new government will act on these findings. Beyond potential plant restarts, Mertz also expressed interest in advancing new nuclear technologies, particularly smaller, cost-effective reactors. A CDU-led government would also likely be far less resistant to nuclear's inclusion in the European Union's green taxonomy, an issue that has had major policy implications for the sector. This would mark a significant departure from the anti-nuclear stance of previous administrations under Olaf Scholz and Angela Merkel, both of whom prioritized moving Germany and the broader European market away from nuclear, even as the energy crisis concerns mounted. For those tracking uranium markets, this political shift could have long-term implications, particularly if Germany re-engages with nuclear energy policy in a meaningful way. Cameco subsidiary and reactor builder Westinghouse now claims it can construct an AP1000 reactor faster and at a lower cost than previously expected. Partially owned by Brookfield Renewable Partners, Westinghouse has applied lessons from past projects, including the abandoned VC summer reactors, which may still be revived, and the recently completed Vogtle expansion in Georgia. While Vogtle ran over budget and behind schedule, the CEO of Southern Company, which operates those reactors, now anticipates that Georgia will eventually require 10 gigawatts of new large-scale nuclear capacity. Brookfield and Cameco jointly acquired Westinghouse last year, and despite some early integration challenges, the partnership appears to be finding its footing. Cameco stands to benefit significantly given its role in both uranium mining and nuclear fuel manufacturing, critical inputs for Westinghouse's expanding reactor fleet. Unlike next-generation designs still navigating regulatory hurdles, the AP1000 is a proven technology now benefiting from streamlined construction processes. With Westinghouse optimizing costs and Cameco securing the fuel supply, deploying these reactors could be more economical than ever. That is, if there's enough uranium to fuel them. The uranium market is already tight and getting tighter, as utilities worldwide work to expand their nuclear fleets while simultaneously increasing stockpiles in response to geopolitical uncertainty. Uranium prices appear poised for sustained upward pressure. Key risks and factors include Niger's military coup, which has halted Western-led mining operations, the ongoing war in Ukraine, and escalating trade tensions. Both the U.S. and Russia have imposed uranium export bans on one another, and with Donald Trump signaling a more aggressive trade stance, a tariff war looms as a potential wildcard. Through all of this, Canada and its largest uranium producer, Cameco, remains a stable supplier. As Westinghouse accelerates reactor construction, the market will be watching whether uranium supply can keep pace. Laramide Resources has delivered a significant update to the mineral resource estimate for its Westmoreland uranium project in Queensland, Australia. The updated estimate incorporates drilling data from 2012, 2023, and 2024, making a substantial increase from the previous 2009 estimate. Westmoreland now holds a total indicated resource of 48.1 million pounds U3O8 at 770 ppm and a total inferred resource of 17.7 million pounds at 680 ppm. That's a 34% increase in indicated resources and an 11% increase in inferred resources. The bulk of the resources, 70%, are now in the indicated category, strengthening confidence in the project's potential. CEO Mark Henderson describes Westmoreland as one of the world's largest undeveloped uranium deposits, with the potential to be a top 10 global uranium mine. And that wraps up your Uranium Spotlight coverage for this week. For more news and events from the world of uranium, please tune in next week to Uranium Spotlight.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to delivering the latest news and events shaping the uranium fuel market and its critical role in the global energy landscape. Brought to you by Purepoint Uranium Group. Purepoint actively operates a portfolio of advanced uranium projects in the world's richest uranium district and has established partnerships with industry leaders. While our passion for this subject is undeniable, it's essential to clarify that the information presented here is not investment advice. Instead, our goal is to offer an unbiased and comprehensive review of recent events that could impact uranium prices. Join us again next Tuesday for Uranium Spotlight.